Okay, let's go ahead and go through the solution to the assignment on consolidations with accumulated other comprehensive income and other comprehensive income. And again, here we've got our random numbers. Each of these permutations either has positive AOCI and negative OCI for the year, or vice versa. There we go. This one has negative AOCI and positive OCI. So you had one or the other. Neither one is any harder or easier than the other. So again, let's go ahead and copy and paste as values. Okay, what do we need to do? On January 1st, 2020, Big bought 82% of Little's voting stock for $218,019. The fair value of the non-controlling interest on that date was $47,857.83. Little's book value was this. All of the assets had fair values equal to book value. Little had the following balances at January 1st, 2020. We've got, again, common stock, retained earnings, and a positive or credit balance in accumulated other comprehensive income. Little's information for 2020 is as follows. They had reported earnings of $57,849. They had negative other comprehensive income for the year, and they declared and paid dividends of $34,102. And your task is to prepare equity method and elimination entries for 2020 and complete the consolidation worksheet. Now, first, let's go ahead and just confirm that there's no differential. The fair value of our share was $218,019. The fair value of the non-controlling interest was $47,857 for a total of $265,876.83. The book value was also $265,876.83. So there's no differential. So even though, again, all assets and liabilities had fair values equal to book value, and there was no goodwill. So nice and easy on that front. So first, let's go ahead and do our equity method entries. So what do we have? I apologize for that. When my mouse goes off the screen, it goes to the background. Equity method entries. We have our acquisition, just to keep everything honest. Acquisition cost $218,019, and that's a credit to cash. And now we have income, dividends. There's no amortization, but we do have other comprehensive income. So income, our share of Little's reported earnings, and again, our share is 82%, times their reported earnings of $57,849, and so that's our investment income. Dividends, we're going to receive our share, 82%, of the dividends for the year, $34,102, and that's going to reduce our investment. And then finally, our share of the other comprehensive income. And again, they've got negative other comprehensive income, which means we have negative other comprehensive income. So a debit to OCI for our share, 82% of the OCI, and that is going to reduce our investment. Oops, I should go ahead and make that showing up as a negative number. There we go. Okay, income, dividends, and our share of the OCI. And again, they had negative OCI, so we have negative or debit OCI. Okay, our elimination entries. As before, we have our S entry, eliminating common stock, retained earnings, and we also need to eliminate the beginning of year accumulated other comprehensive income. Let me make these a little bit wider. There we go. We also need to eliminate the beginning of year accumulated other comprehensive income. So beginning of year common stock is that. Beginning of year retained earnings is that. Beginning of year AOCI, again, beginning of year AOCI is a positive or a credit balance. So to eliminate that, we're going to debit AOCI. Again, there's no differential, no goodwill, so we're going to take that total, whatever that adds up to. Let's go ahead and figure that out. And again, that's that's the book value of 265,877, 265,876.83. If I make that wider, it'll go up to the pennies. And we're going to split that 82% to the investment in Little. This is an 82% owned subsidiary. 82% to the investment in Little. The other 18% to the non-controlling interest. So nothing new under the sun there, except that we've got this new equity account. Okay, so we have our S, A for amortization, not applicable, I for investment income. We have, so again, these dual income entries, and basically what we're doing is we're reversing that one, like we always have, and we're also going to reverse that one. So we had positive regular investment income of that, and we recorded a debit to OCI, so we need to get rid of that, so we're going to credit OCI and debit the investment in Little. Okay, D for dividends. Same as we've always done. We're going to go ahead and credit dividends declared for the amount of the dividends. Get that right off my worksheet here. And that's going to be split 80-18 between the investment in Little and the non-controlling interest. So the parents share 82% of that. The non-controlling interests share 18% of that. Then finally we have our income to the non-controlling interest entries. And again, just as we had dual investment income or dual parents income entries, we're going to have dual income to the non-controlling interest. And it's going to be the same basic pattern. We're going to allocate with a debit some income to the non-controlling shareholders, and then with a credit we're going to allocate some of that negative OCI to the non-controlling shareholders. So income to the non-controlling interest, let me shorten that, Inc to NC interest, they're going to get their percentage, 18%, of the subsidiary's reported earnings, 57,849. So you can see I just did something wrong there. Okay. Bear with me. There, I fixed this. 18 times that. There we go. This is just like every other income to the non-controlling interest entry we've ever done. Now we're going to allocate some of that negative OCI. Now again, OCI on the income statement is negative. It's a debit balance. So to allocate away part of it, we're going to credit the OCI their 18% of Little's OCI for the year. And again, I got to clean that up because that's a negative number. I need to make it positive. And that's going to be our non-controlling interest. Okay, so there are our elimination entries. Now again, we're back to the matter of basically posting these from journal entry form to the columns of our worksheet. Most of this is just like it's always been. The only things new are we have this AOCI to deal with, we have the OCI to deal with, and we have the OCI to the non-controlling interest. Again, the OCI to the non-controlling interest is analogous to the income to the non-controlling interest, but it's in the different income statement. It's in the statement of other comprehensive income. Okay, so let's go ahead and post this good stuff. Just going down the list, we're going to go ahead and post a debit to common. We're going to go ahead and post a debit to common stock. We'll post a debit to beginning retained earnings, and we'll post a debit to beginning AOCI. We'll go ahead and credit the investment in little, and we'll credit the non-controlling interest. Next elimination entry, I. We're going to go ahead and debit investment income and credit the investment in little. We're going to debit the investment in little and credit OCI, other comprehensive income. D for dividends, we're going to debit the investment in little. We're going to debit the non-controlling interest. And we're going to credit dividends declared, just like we've always done. Then finally, for the income to the non-controlling shareholders, again, we have two different allocations. We're going to allocate to them their share with a debit of the regular earnings. And we're going to go ahead and debit the non-controlling interest and credit the other comprehensive income to the non-controlling interest. Okay, and again, just to make sure, let's go ahead and sum those to make sure our debits equal our credits. Then total debits, total credits, everything is right with the world. I got total debits equaling my total credits. So let's go ahead and work through these. Revenues, we simply add across. Expenses, we simply add across. Investment income, if you want to add that across just to sort of as a formality, this is a credit offset by a debit. Consolidated income, we work our way down as we always do. So revenues minus expenses is our consolidated income. We allocate away $10,000 of that to the non-controlling shareholders, so our income to the controlling interest is the consolidated income minus the portion that goes to the non-controlling interest. We take that result and move it down to the balance sheet as ending, we take that result and move it to the statement of retained earnings as our income for the period. Let's go ahead and continue with the retained earnings and the balance sheet and then come back and hit the other comprehensive income. Beginning retained earnings. Credit plus credit minus debit equals our beginning, basically, again, as always, we're eliminating the subsidiaries' retained earnings. We've already got our income there. Dividends, debit plus debit, minus credit. Ending retained earnings, beginning retained earnings, plus income minus dividends. And that goes down to the balance sheet as ending retained earnings. Let's go ahead and polish off the rest of our balance sheet. Assets. Investment, debit plus debit minus credit. Important check figure, that worked out to 0, so that's very reassuring that I'm on the right path here. Liabilities, common stock, credit plus credit minus debit. And lastly, the non-controlling interest, credit minus debit. Okay, last thing is to do the other comprehensive income. And here's where we need to be. This is the new part that might trip you up. Again, income is positive. Positive income is a credit, right? So that means that this is a positive number. These are debits. These are negative numbers. So when we carry this across, we've got negative $3,803. We're adding $1,713, so we're still going to have a negative number there of negative $2,090. This is a credit. This is a positive number. So a negative $2,090 beginning balance, negative $2,090 other comprehensive income. We allocate away $376 of that other comprehensive loss to the non-controlling shareholders, leaving that much for the controlling shareholders. Take that, transfer it down to the statement of other comprehensive income. Beginning OCI, again, these are positive numbers, so these are credit balances. So we've got positive plus positive minus negative. So we had a beginning AOCI, and again, this is prepared from the parent company's perspective, so the BIG's beginning AOCI was 6824.86. We're cutting that down by 1700, so the ending AOCI is 5111.06, and that goes to our balance sheet as ending accumulated other comprehensive income. And just to sort of put the finishing touches on this, we'd say our total debits are that, our total credits are that, plus that, plus that, plus that, plus that, and God willing, hey, look at that, they balance. Okay, so that's the solution to the consolidation with other comprehensive income and accumulated other comprehensive income. Again, the part that's new here is the existence of this AOCI at the beginning of the year and the presence of this other comprehensive income we have to deal with. The tricky part of this question was that you either had a negative other comprehensive income, so basically it's another comprehensive loss, or you had a negative or debit balance in beginning AOCI. Again, I don't think one is any worse than the other. They're just both sort of complicated in different ways.